All right. Good morning, everybody. How's everybody doing on this fantastic Thursday morning? We're going to take a look at some assets. The market has been open for a little bit. We had some news come out today. Bright screen. Initial jobless claims. You can see that last month we had 246K. Forecast for this month was 200K. So basically they were looking for less than that. That would mean that the economy's still in good shape. 228K means that we are starting to see that jobs are falling. So this is like a precursor to what everybody's afraid of as far as the market's pulling back, recession, if you will. You can start to hear the voices across the mainstream media platforms. More and more talks about recession and how it's going to come. Basically been waiting for jobs numbers to start to deteriorate. And we've gotten that. We do have a slight risk-off tone across most sectors. Let's go pull up the sectors. And here we go. All right, so for anybody that's new to the channel, the yellow line just distinguishes the yearly open, as that is the beginning of the year. That is the new trend, right? You got a fresh new year, so fresh new trend. As you can see, the DXY is pretty much choppy. You're trading around the bottom edge of that trend. There is a monthly support down there. That is what is struggling to keep the DXY from breaking down. If we go to tech, you can see tech is pretty much leading the rally. I don't know why that is off, but tech is leading the rally. XLC, which is communications here. Let me pull it up over here because obviously this is the chart. All right, there we go. This is the communications sector up on the year. These are your risk off or your risk on type plays here. Energy sector had a nice pullback into the yearly open. That yearly open is currently acting as resistance due to a nice oil pop that we got since OPEC is essentially controlling the taps, the on and off button, if you will, that controls supply and demand. So we got a nice pop in oil the other day, bringing the energy sector right back up to that yearly opening range. Now, technically, if there wasn't any kind of market manipulation going on here, this would be an opportunity to sell, right? This would be an opportunity to look for downside pushes. But since they are controlling the markets, then those technical signals are going to be less keen to work out as much. Here's your financial sector, risk off, materials, XLI, right under. So industrial just pulling back off the year. Consumer staples just broke out fresh. So you can see how this thing was accumulating under the yearly open, waiting for capital to rotate back into the sector. Capital will rotate back into this sector if there are any more risk off things that start to happen, like more jobs start getting cut, this and that, then they will take their money from tech, from the high flyers, and start to rotate those assets back into your safer, not growth, but the other play, right? You got two main plays: growth, which is your higher beta stocks, and then you got your safety play here. And you can see that you are starting to get the pop there. Here's healthcare, strong move this week up. Real estate has been getting absolutely squabbled, but as far as where it is in regards to yearly open, it's not in a bad spot. However, this is an area where I would expect to see more selling pressure. There is your utilities fund, and then of course your your spiders. Here's the S&P 500, mainly tech. Same with the Qs, right? Got a nice push up due to tech. Your Dow Jones showing you more along the lines of value and not growth, struggling at the yearly open. And then the small caps, it's mainly gotten destroyed based on the banks. Let me get this back over here. I'm just trying to set the overall narrative. Well, I'm not setting the overall narrative. The market sets the overall narrative. So where does that leave us with Bitcoin? Along with the regional banking mishap, you got commercial real estate is what everybody's concerned with this time around. So people that are looking for like an '08 style crash in the market, it's due to commercial real estate, not the same thing as what brought the market down in '08, right? Your commercial real estate, your individual small regional banks are the ones that hold most of those loans. And they didn't do anything wrong. So basically, they were hedged the right way. It's just such an aggressive, fast pace in your rates being hiked. Essentially, if you have everybody taking their money out of the bank at the same time, i.e., doing a bank run, then that puts all those loans into very bad shape, or puts those banks that have most of those commercial loans in bad shape. So that's where they're looking for things to unravel. So it'd be a credit problem. And a credit problem, well, let's be honest, would not be good, seeing how the small regional banks hold 70% of all commercial real estate. So, I mean, you got Google starting to do some layoffs. We are seeing risk off plays happening in the currency futures in the Swiss franc. We pull up the Swiss franc. You can see here, nice pop, and Japanese yen, nice pop. You can see the Japanese yen is actually struggling with the yearly opening range currently. Right now. All right. So we were above it briefly at the beginning of the year. Then we broke down, came in for a pullback. Now we're right back up there. So if it's not going to be a risk off environment, like if the Fed has fixed inflation, which I should point out is still very much up there, then this would be a selling opportunity. So you'd be looking for long JPY plays. As long as JPY is not the base currency, you would want the quote currency. So like USD JPY or Aussie yen or Canadian yen, something like that. You would want to see those. You would want to be shorting those based on potential risk off scenarios. But anyways, Swiss franc is the one that we were mostly paying attention to this week. We were looking, well, this week and last week we were looking to get short CAD Swissy. We get rid of the Bollinger Bands. I don't know why they're even up. We were looking to short CAD Swissy, and you can see that after playing a little bit of games here, we are now starting to see that breakdown. Obvious bull trap right there. The weekly resistance level was the first level that we were looking for potential shorts. However, we did get the breakout above, so we were just kind of letting this daily resistance build in. We did take a successful day trade on this day here. Actually, it was on this day when we traded up to resistance. We got short, and then we traded it all the way down to this bearish candle's close. That's where we took profits. We moved our stops to break even, and then later on in the day, you got the bounce right back up to there, and then the next day you had the bull trap form, which that was just to make sure that it got anybody that was short. It even took out this swing high here, and then boom, there was the move. Did not come in for a retest of anything that I would have deemed as an area to get short. But it looks like that weekly res so far has held, and we would expect this to continue lower. If we pull this up over here on this side with the 21, you can see that you are still a little bit stretched out from that, but this is a pullback. I mean, that is what is considered to be a bear flag. It's starting to get a little bit long in the tooth, so we would technically want to see it break down from weekly support before we start to look for any more short entries, or we can watch the newly formed weekly resistance that's formed right there at 0.67719. So back over here to Bitcoin. Here on the weekly, you can see very much stretched out from the 21 exponential. Typically, when you're trading this far away from the mean, if you're viewing the 21 exponential as the mean, you would expect a reversion or a pullback to get in closer to the mean before the buying starts again. I would assume that we're seeing this struggle to break down based on a few things. This actually got a pop with the 2-year bond yield. As the 2-year bond yields came off, Bitcoin got a pop during that same week, which is not typical. But as of right now, it seems to still be trading with that. And then Michael Saylor added to his portfolio, which was, big news. Oh, that's not right. Just bear with me here. As that is enough, really and truly, to make people buy into this market. I mean, the way they think is if Michael Saylor is going to be buying so much, then the market must be going to go up, right? Well, that's not how this works. Right there, MicroStrategy has acquired an additional 1,045 Bitcoin for $29.3 million at an average price of 28 spot or $28,016 per Bitcoin. So essentially, that means MicroStrategy as a company holds 140,000 Bitcoins acquired for $4 billion at an average price of 29,803 per Bitcoin. So obviously anything under 29.8, he is underwater on that position. Now, you must understand something, that he is hedged. Please do not think that he is just holding that position naked. He is not holding that position naked. So it does not mean that Bitcoin is going to sustain any kind of bullish momentum. However, if we look at momentum indicators, let's go to the daily here. You can clearly see this thing is wedging up. Getting tighter and tighter, right? Wedging up. There is a lot of stuff here. You got new monthly resistance holding price. You're trading above the monthly 21. So far, we've been in this month for a week. It does look like the low of month may potentially be in. It's not a very deep correction on a monthly candle. I would expect this to trade lower and then look for support, but it's not doing it. So as of right now, we are just watching the lowest daily supports. Right now, you're currently bouncing off of 27,811, which is daily support that was formed on Monday, April the 3rd. You have another daily support all the way down here at around 27,142. And then the next one would be 26,976. A breakdown from this region. I'm not a pattern trader, but pattern traders are out there and they will trade based on these patterns. This is what is considered a rising wedge. So it is a bearish formation or a bearish pattern. It's not bearish because if you're making higher highs and higher lows, typically that does mean that you are moving up. So that is bullish in a sense, but people look for these type of patterns to typically break down to the bearish side. So there are a lot of shorts being built up here. If I pull up Glassnode, you can see that there is also a ton of accumulation happening up here. So you got a lot of buying and a lot of selling going on up here. Here is your futures open interest. So when we did get that pretty deep little correction, ever since then, open interest has been building to the point to where now it's been pretty much flatlined for about the last 2 weeks. Here's your put to call ratio. It was moving up very high. The higher price goes, the higher this typically will go. We did have a breakdown in those puts. I don't know what that was due to, but still, nonetheless, you still have a lot of puts when it comes to actual open interest. And then I want to show you one other thing, the implied volatility. So these squiggly lines down here, this is your options expiration implied volatility. You can see when you get the spikes of volatility, when these bands widen, that's typically when you would be looking for a big move, or once they start to break away, you are experiencing that rise in volatility. Well, notice how for the last several days since March the 22nd, implied volatility has been very tight. Very tight. You can see that in the candlesticks. You don't need to know that implied volatily is tight. You just need to look at the candlesticks. Typically, when you have more than a week or two of trading absolutely sideways and the candlesticks are making smaller ranges, chopping up and down. I mean, let's be clear. There is no clear signal, no clear pattern, no clear obvious support or resistance outside of the outer band. So what I mean by that is these two white lines would essentially be your operating range based on the candle body structure that has been already traded in. So as long as you're trading above 26,980 and as long as you are trading under 28,474, you are in a range, and it makes it difficult to take high probable trades in the middle of the range. But you can still find high probable trading and entries as long as you stick to trading within the range if you have higher time frame levels to watch. For instance, today's open, a short trade could have been taken in this daily resistance. And as long as you weren't expecting, a move down to 25K or 10K, you can absolutely take profitable trades. You just got to know where your target is. And where would be a good target for that entry? Right there. Right? Right there. Because for the last 4 days, that's where your candle bodies have been trading. So that's your high probable range currently until you get a daily close above or a daily close below. So whichever direction Bitcoin closes today, that's where you will be looking for the next high probable entry. So if you close under 27,811, you're going to be watching this price down here for potential bullish entries if you are indeed bullish. However, if you break down below this, then move this red line up to the line chart, you will have a breakdown, because most professional traders operate on line charts. They don't really pay too much attention to the wicks. So this would actually look something like this, right? Or if you want to make it tighter, you could do something like this, and then one would be able to say, well, technically, you are already experiencing a breakdown. Trend lines are very subjective. That's why we don't use them that often, right? We just don't, simply because they are so subjective. But if you want to, the way that I look at them, I use the wicks as well, and I just put the trend line on the outside of the wicks, as that gives you a clear breakdown. If you break down and start closing candles under the low end of the trend line, and you are anchored to the lowest wicks, then there's no doubt about it, you have a breakdown on your hands. But in this scenario, in this narrative, you're still just merely looking at that as a pullback, regardless how much momentum comes out of the downside move. Unless you blast all the way down to here in one day, you know what I'm saying? Then it's nothing to be concerned with, because the pullback to 24K is still just that, a pullback, because your weekly 21 is so far away from near-term price. And that goes the same for your volatility metric, which is the RSI, right? You're still very much trading above the 50. So any pullback to the 50 or close to the weekly 50 would still be considered a bullish pullback. It is only when you're closing multiple weeks under the 50 could you say that the bears are now firmly in control of price. On the daily time frame, that's different. Obviously, if you're looking for a daily pullback to the 50, which we typically will for intraday setups, but for our longer term macro view, we focus mostly on the weekly. But when we are taking intraday setups, if we get under the 21, we will look to short it, just for the intraday setups, just for intraday shorts, not looking for any bullish continuation or bearish continuation, because we look to operate inside of the high probable areas. We've already identified the high probable areas. We know what they are. We know where they are, so that's where we are looking to enter positions. We don't look to enter positions in the middle of the ranges, because you will get chopped up. All right, so let's go into today's price action. Right here is the news that we got at 8:30. We had a spike up. Immediately we sold off. We did not make a fresh daily low, and we are bouncing. Why? Why are we bouncing here? Well, that's simple. You have demand right here. All right? This is what we call a Heath level, or an intraday demand zone. You can bring up the volume if you wish. You can see how you did get a high amount of volume on this wick. So that does suggest that people were buying in this candle. The fact that you left the area aggressively after also suggests that there is more buying going on down here than selling. If there was more selling down here, or if supply exceeded demand, you would see price continue lower. This is struggling to stay under this supply zone or demand. Sorry. You did get a 1 hour closure under that, so that would typically negate any bullish setup. However, if you look at the 2 hour, you can see that demand is also 2 hour support. So now you have this crazy ass candle. Little body, big wick to the out, big wick to the down. So as long as this candle right here trades inside of this candle, there is no clear signal, because this candle broke down and closed below. This is what we call chop. All right. You got 1 hour and 5 minutes left on this candle. If you close above this region here, then you could look for more upside. But if you close under it, then that puts more weight to the downside. That suggests that your intraday trend, which is obviously down, is still intact. All right, here is the 2000 hour candle. This is your daily open right there. You can clearly see the direction your daily candle is moving. It is moving lower, not higher. So today, the bears are running the show. If we pull this out, I mean, this is choppy. Choppy, choppy, choppy. Very difficult to trade this. Very easy for retail to get chopped up. Very easy. So if you're looking for liquidation breaks, you could potentially have a little bit of a move to the downside. Same goes for the upside here. Liquidation right there, up. But you need to have discernible targets before you enter a position. You can't enter a position and then ask me where to put your stop. That's not how this works. You must have a stop loss and an entry and a target in mind before you take a trade. Always. Always. Because if you don't, then you're just shooting in the dark with your eyes closed, trying to hit a quarter 100 yards away. It's not going to happen. It's not going to happen. You have to learn to put the probabilities on your side. And even then, you're going to miss, because market is random. We have random market violence that happens all the time. This was bad news, and you got a spike up on bad news. A spike up into supply, and then immediately it was sold off. That is the trade that I took this morning. I will show you that trade. That trade's about to get stopped out also. Right here, I'll just show you this way, because there's no way for me to Maybe I can do it like this. Yeah. All right, so here the blue line is my entry. You can see on the spike up, I waited for it to start to come back down. There is resistance there. Let me move this. Right here is that resistance, the top of the red line. Also, your open was right above it, right? So as long as we're not trading above the open, above the resistance, then I'm still looking for it to go lower, especially because the news was not bullish, right? It was bad news. So I essentially took the short roughly right in there. And then as price traded down and got close to support, this support here, I took profits. So as price spiked up, I got short, put my stop loss above, and then as price traded down, I took profits. Now my stop is setting just below my entry, and if price continues to trade up, the remainder of the position will get stopped out, but I already booked a realized gain. So no matter what, I cannot lose money on the trade. All right? That's the way we try to teach you guys how to trade, because it essentially means that you can be on the wrong side of the market. You're not trying to guess which way the market's going to go. You're merely trading where the market has already been. And we know that in a choppy environment, the market likes to trade back and forth. It oscillates, just like this oscillator down here. This is an oscillator. It oscillates inside of 2 price points. And you are oscillating inside of 2 price points. As of right now, your oscillation is occurring between these 2 price points. Here, right? Though that's your oscillation. That's your open of the day. Oscillated back to the open. After you set an open, you run lower. Then you come back and you oscillate higher back to the open. Then you set a new low here. Then price oscillates back to the open or resistance. And then it oscillates back down to support. Do you see that? So that's all I'm looking for. If I get short here, and if it breaks down, and if it continues, then yay. But I do not expect that ever. You can't expect that ever because price oscillates. That's what it does. It moves back and forth. It never moves in a straight line. But when you do sometimes get lucky enough to take an entry and then price does break out or break down, then that's just icing on the cake, and your realized gains will end up making you more money than the initial position. And that's the goal. This way we don't have to predict anything. We're not trying to predict directional bias. We are simply saying, well, if price oscillates back to the top end of the range and price has been range bound for 12 freaking days, then there's a high probable chance that it will oscillate back to the lower end of the range. Well, that presents an opportunity. So boom, pow, there it is. Price is now moving up to my entry or my stop loss currently. See? Oscillation. Choppy. But there is, there's a means and a way to make money in that. Now we have more of a bullish bias. So typically I would much rather take bullish entries, but I focus on the last 3 days of price action because the last 3 days of price action typically shows me order flow. And you can clearly see that on the last 3 days, you do have order flow essentially looking more weighted to the downside. Hence the short trade. Now, or you could say you got a head and shoulders here, right? Right shoulder, head, right, left shoulder, whatever. Left shoulder, head, right shoulder. So if this is what we're going to be looking for, then any spike up to here, you don't want to be a buyer there expecting a breakout. The problem that I had with today's range, and I just got taken out. So any unrealized P&L that I had on that open position is gone, right? But I am no longer in the market. I no longer have any risk on the board at all. It is gone. And I made money on the trade. Brought my P&L up by about 32%. Anyways, but that was with using 25x leverage. I don't suggest that you guys use anything higher than 10x, please, until you start to understand this. Because the higher in leverage you go, the more the fees they take, the more of a move you need in order to just break even on the trade. But I just want you to learn the process first. Learn how to analyze price the right way first. Then when you start operating with real funds, then you can start to see how just basically by getting into a position, you are automatically in the hole. You automatically lose money just by taking the trade. So if you exit the trade in the red, you are also going to lose more money than what it shows you losing because A, you got charged to be put into the trade and that comes out of your P&L. Then you got charged for the lost amount of money that you took on the trade. Then you get charged another fee for exiting the trade. So yeah, there's a lot more to this game than just, it being easy as 1, 2, 3. But anyways, what I was looking at is this was a pretty big down expansion day. And that's after a nice bullish explosion. This was a breakout. And unlike this breakout over here, where you broke out, you were not instantly sold right back off. It actually broke out and traded sideways for a bit. So it did look like we were going to see sustained upside, but we didn't get that. We traded right back down into the range. So since we traded right back down to the range, order flow to me is more bearish. But the optimal trade or the best scenario would be to look for longs at daily supports. Those are the areas where you want to be looking for your entries, as those areas typically, if you're on the right side of the market, give you the better chance for seeing continuation because you're on the side of the overall trend, not taking a counter trend trade. The markets seem to be moving up, right? These numbers on the SPX, US 30, US 100, and the RUT, all of these numbers were moving lower when I took the trade. They were consistently moving lower, right? I don't have to watch the chart in order to know what's going on in the overall market. I just need to watch percentage change or the actual price change, right? This shows me that you're $7 under the open. This shows me that you're $78 under the open. Same for here. You're $12 under the open. Or points or handles, whatever. Whatever you want to say. In Bitcoin's case, it was like 200 and something dollars under the open. So as long as I'm seeing those numbers go down, then I'm watching these numbers go down. I know right where I'm looking to get out. I don't even need the chart. I just need this. That's called level 1 data. That's all I need. But once you understand the overall, the way that price moves and what candlesticks actually represent what they actually are, the better off you're going to be. The more likely you're going to be profitable in the long run as you can get more consistent with your entries and exits. And if you've been following me for any length of time, you know consistency is key. Yeah, Michael Saylor buying the top. He damn sure could be. Yes, he could be. You have a complete balance of supply and demand up here. So simply by him buying that much Bitcoin up there would also offset that. You would think that that should pump price, right? Well, not if someone is taking the opposite side of that trade. Not if he bought as somebody else bigger was selling. Now, he didn't buy 140,000 Bitcoins up here. He just has an overall price up here. He bought 1,000 Bitcoins up here. So if you have someone that's sold 2,000 Bitcoins, that's going to offset the 1,000 Bitcoins that he bought, and price could ultimately dump. That's why you have to be very careful. And you don't want to look for signal like that or use tweets for signal. Just let the price be your guide. Let price show you where it's already traded. That way, there's not, price oscillates. So you know that there's probably going to, unless you don't want to do that in a very rapid bullish trend. Meaning you're not trying to short as price is moving up like this, because you're going to get ran over likely. Once a range has formed, then you can operate in it with a high likelihood of consistency. Once the range has formed. And even then, it doesn't mean that you're going to get there, right? It doesn't mean you're going to get there. It could be a very small range day. Some days your ranges are bigger than others. Like yesterday was a pretty big range, even though it closed essentially unchanged on the day. You still had, quite a big movement there. But it did look like we were potentially going to be looking for a lower oscillation. So that's why I took the short. But the better trade would have been to wait for the support, see if support held. Because notice here, if you were watching this support on this day, it did not hold. So if you blindly just bought 28,035 expecting a bullish pop, you got stopped out. But you can view this on the hourly, right? If this thing is going to continue above, you would want to see something like this. There. If you buy that, put your stop there. All right. Where's your profit taking range? Up there. Since price rolled over and came back to your entry, you would want to exit the position for a small loss or break even, because it's not doing what you want it to do. And I promise you, most of the time, especially since like all of this happened when you took the position, you have to think that that's likely going to be, more or less you're trying to basically buy a falling knife, right? But that's what we do in some cases. And then right there took everybody out. Boom. So that makes people bearish, even though it's not a bearish signal. Very next day, what a beautiful trade. Had you just bought the close and targeted the open of the previous day's candle. This is a trading opportunity. On this candle. right? There's a close above, close above, close above, retest. That's where you'd be looking for entry. Not only do you have a beautiful, flawless retest of that, you also have a supply zone there, or demand zone there. And then you would have been taking profits 2 hours later. Boom, boom. 3 hours later. Right? Right. Love it. And that's how you're going to be a future legend. By learning to do that and nothing more. Be consistent in the way that you enter. Be consistent in the way that you exit. And then watch the money flow. Obviously, you have to own your skills a little bit. You can use other indicators to show you which direction you want to be aiming for. If you can't quite see order flow just yet, use a simple moving average. Use 1, the 21, or the 20. It shows you the direction. If price is above it, look for longs. If price is below it, look for shorts. But do it at resistances. Don't look for shorts at the low of the wick. Or don't wait for there to be a big breakdown and then look to short that. Because you know that price is going to oscillate more than likely back up to where it came from to retest supply to see if there's actually supply there. Is it supply? Is it the beginning of a new trend, or was it just someone offloading a big position? Or did you get a whole new dynamic or shift in demand on that lower push? So, I mean, it can be a crapshoot sometimes. And this can be very annoying and disgusting for some people to trade. Like, they just want Bitcoin to continue to go up and 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 never stop. Meanwhile, people like me are making a freaking living off of trading this low volatile, very tight implied volatility. So that way, when I do take a position and I am on the right side of the trend and all of those metrics do work out and I do catch a breakout and a short squeeze, then you can sit back and just, shine in your own glory as you watch as Bitcoin just wrecks people left and right, right? Bask in your own glory as you behold your own greatness. Please understand it is 100% luck. I did not expect Bitcoin to move over $10,000 when I took that entry, as I trade the same way every single day. Entry was there. I took profits there. I left a small piece on, and since that small piece was still levered, obviously, that move right there paid me big time. Now I have removed the majority of my funds off exchange. Okay? I am moving the majority of my funds off exchange. The only thing that I'm leaving on exchange right now is tradable capital. That is it. I am not leaving a lot of spot on exchange like I was, right? I was allowing the spot to build up to like 15 to 20 grand, and then I would pull it off, drop it back down to like 4 or 5 grand, trade it back up to 20 grand, and then drop it back down, doing that. But now with everything that's going on inside of the banking catastrophe and everything else, the SEC literally going after Coinbase, literally going after Binance, literally going after Kraken, with all this uncertainty out there, the only amount of money that I am leaving on exchange is tradable capital. That is it. What I have inside the futures account. So now I have to be a little bit more picky about which trades I take, because I don't want to be depositing more funds if I blow up an account, which you can do by using 25x leverage or 50 or 100x. And if you do, blow that, then you got to deposit more funds, right? You don't want to be depositing funds. You want to be withdrawing funds. That's what you want. You want to withdraw. Never deposit. Never. You withdraw from your trading profits. If you're not there yet, hopefully someday you will get there. So now that we've seen a little bit of sector rotation going on, one of my favorite plays that I am currently watching right now for potential shorts is Meta, Facebook. All right, there's a reason for it. The reason is simple. All right, we liquidated last quarter's high, and what have we done? We've pulled back. All right. So the next liquidation point or next bullish target on Facebook or Meta would be here to 1194. Sorry, 224.30. That is the next potential bullish target. So as long as Meta or Facebook is trading above 212.17, I cannot short it. I cannot short it. Why? Because this is the next bullish target. So if you're trading above last month's high, then that means there could potentially be a short squeeze happening. If there is a short squeeze happening, I can't step in front of that. I must let it continue. Then I will see what happens when it gets to here. But as long as it struggles to maintain any bullish posture above to 1120, then I can look for shorts. Look at today. Where did it trade to today? So far. Here's your open on the day. Nice gap to the downside. filled the gap, bullish pop. Right there. This is yesterday's close. The lower line is yesterday's close. The upper line is last month's high. So while we were trading above last month's high, I cannot look for shorts because this could potentially be a short squeeze because retail shorted that right there. And not only retail, other people, right? Firms will short that as well. So if there is going to be a capital rotation back into like healthcare and stuff like that, then that capital is going to rotate out of Facebook or Meta. Now, I don't know that's what's going to happen. Obviously, I have no clue what's going to happen. I never know what's going to happen. But that's just the way the strategy works. That's just the way I operate. As long as we're trading under this right here, then I know that there wasn't enough demand up here to sustain a bullish rally all the way up to there. Now, it doesn't mean that tomorrow or the next day it doesn't gap up there and then go, because it can do that. It can do that for sure. That's where I have to mitigate my risk. And I can do that simply by buying options. I can mitigate that risk by buying options, because that each contract I buy is what I'm willing to risk to be wrong. As of right now, 8 days out, to short this, I would have to buy $215 strike puts. Or, 212 or 210. 210 is out of the money. $210 is out of the money here. And that puts it right there. So just to break even on the trade, I would need price to get to about 208.50 just to break even on the trade. But I have 8 days for it to drop. Right? And that's $325 per contract. So in a sense, I would be risking $325 on the trade if I think that it's going to go lower. So I would be risking $325 to see if in 8 days Meta is trading down in here. So I'm not going to take that position, obviously, because we've already filled the gap and we're pushing higher. Also, we have these things look like they're starting to catch a bid. There's your SPY. Initial gap lower, sets low of day, boom, high of day. So a choppy day, we would be expecting this thing to start to trade lower again. What is this level? Nothing burger. It's monthly resistance. Last month we broke above and closed above. So don't really want to short it just yet. But as long as it stays below last month's high at 409.70, I could potentially short it. But I would be looking for this area down there for the pullback. This thing has been moving straight up. It is range bound. There is your yearly open. That is your yearly low. This is your yearly high. So as of right now, your trend is bullish. You could potentially be targeting the yearly high. So by looking to short this means that I could potentially be on the wrong side of the trade. As of right now, it is structured bullish. And the same goes for Meta. Meta's my favorite one to watch for potential risk off scenarios. That's it. I'm not looking to short it because of any other reason. I'm not trying to short it because of bearish divergence or any of that. It's just the fact that if the markets are going to get spooked based on the fact that we are starting to see more of a probability that we're likely going to see a recession, then I need to start looking for some of these big gainers on the year to pull back, because some of those big gainers on the year will be where capital rotates from. So all the people that jumped in long on Meta at the beginning of the year will take their profits and rotate into a safer sector. If that occurs, then it becomes my favorite asset to watch for that play. But as of right now, it is very bullish. Last week we did take a profitable trade on it. It took 2 days to do it, but we're still keeping it on watch because, like I said, the more and more they start to talk about inflation fears, the more and more I want to start looking for opportunities for that trade. Wayne Backus, the Discord link, buddy, is hidden behind a paywall. It's in the link of the description if you want to do it. You don't have to. I set it up as a donation-based situation, as I am not selling courses, not selling the Discord either. It's not a business model. I only set it up to monetize the channel. And basically it keeps me busy, right? So it's just a way to monetize the time that I spend explaining things to people. But if it is something that you are interested in, it's less than $1 a day, and the link is in the description. You want the hedge fund tier. Euro USD long from 1.07356 already took profit, stopped to break even. Where would you look to cut position size or take more profits? Still learning how to manage a winning trade. Thanks, Heath. Typically, I look to start to remove more profits once the unrealized gains become substantial, or if a trend becomes really extended. Euro USD. And good on you for getting long the euro, because that has been the trade. That has been the trade since the bottom. And we did call the bottom. Uh, 107, 356. So right in here. So it looks like you tried to get long off a yearly open test. Yay for you, because it worked. Right? Good job. Good job. Once the profits become substantial, I don't know what substantial is to you. You know what I mean? But substantial to me just generally means, like, if I double my money on the trade, like whatever I made on the initial trade, if the unrealized P&L becomes more than that, and it's getting extended in the trend, then I will typically cut it in half one more time and then just leave it alone. Right? I will cut it in half, or take 2/3 or whatever, and then just leave the rest on, because that puts margin back into your account and it allows you to deploy that capital elsewhere. Like, for instance, on this trade that I took for so long ago, I mean, once it set this low, it hasn't been back there since January the 16th. This is April. So in a sense, almost 4 months I've been sitting in a sideways trade. So this trend was getting long in the tooth. I could have dropped it by half and then just not worried about it anymore. Right? And forget about it. That way, if it continues lower for the rest of the year, or even sideways, I don't have too much margin tied up in a position that isn't making any money. In fact, once you cut it down, more, like once you take the initial profits and then you cut it down in half again, then the position size is going to be so small. In a sense, you're going to start losing P&L based on the carry. Just based on the carry, which is something you also have to keep an eye on. The interest rates, right? You'll end up paying to set in the trade. And you don't want to do that for very long, typically. But I mean, the amount of money, it's not going to be a lot, right? The carry, it's not going to be a lot. It just depends on what's what. But on this one, it's literally been weeks. So if it goes up and makes another high, more than likely I will exit a majority of the position and then just leave the rest there for whatever happens. Let it happen. But then, the position size will be so small. This would literally need to get all the way down to like 108 at that point in order to make the P&L sufficient enough to where then you could just think about closing it. Because also that trend would be long in the tooth, if you will. But this thing was sideways for a very long time, and it will remain sideways for a very long time. If we go into a risk-off scenario, because the dollar is still the reserve currency. It is losing its reserve status slowly, but as of right now, it is still the reserve currency. So it's normally going to be treated as a risk-off asset anyway. So essentially, with USD/JPY, you're just looking for the alpha from the carry because USD has higher interest rates, but I'm positioned on the wrong side for that, right? If USD has higher interest rates than Japan, then I'm literally paying to set in the short trade, which also will put slight pressure to the upside just based on the carry. As long as the yen doesn't raise their interest rates very high. When the interest rates get really close together, then the carry trade doesn't matter that much. And it will be less attractive for investors. But when you have wide interest rates from both currencies, then the carry trade is a lot more, it looks a lot better to investors to just set and hold the position. But they would set and hold it long. If the USD's, that's why the USD got such a big bounce in the first place. Because they knew that they were going to raise interest rates. So you had literally all the investors flew into the dollar for the carry trade, just for the interest rate rising itself. That in itself will generate alpha. But now that yield, like, it's starting to come off, right? So it's looking less and less attractive. So that's why I haven't canceled the short. Yeah, that's why I'm still setting in it. And as far as Bitcoin, I am setting in Bitcoin from 16,000 still, 16,540. And I don't plan on exiting that position anytime soon. So as of right now, we're just waiting for Bitcoin to break out or break down. But there is opportunity inside of these weekly candles. You just got to wait for the outer edges to take those opportunities. But remember, don't just blindly short them, because even though that is objective daily resistance, you still get these big long wicks above, right? So it makes it difficult to judge your risk, as you don't know if you're going to see bullish continuation or not. Now you have a new resistance up there. But no matter how bearish or bullish you are on this asset, you can clearly see that the supports are getting higher and higher, right? Your resistance, which was here, then it moved up to here, then it moved up to here, then it moved up to there, then it moved up to there. You literally are making higher highs and higher lows, higher closes, higher high closes and higher low closes. So you are, in a sense, still trending up. It's just, yeah, it's finding a lot of difficulty breaking above that yearly Heath level. That yearly Heath level is there. That is yearly supply, ladies and gentlemen. All right. But right now, as it sits, it does look like it wants to break out bullish, break out to the upside. It's just struggling to do so, and it could take time to do it. But we are losing momentum. Implied volatility is tightening, and when implied volatility tightens, that's when we look for a breakout to occur. So you can see this is your mean reversion channel. You can see how it's narrowing. It's the same thing as a Bollinger Band. Well, this indicator is not the exact same as a Bollinger Band, but if we go out to the daily, on the Bollinger Band, you can see how it's starting. I mean, that's from here to here. That's a wide, girthy Bollinger Band. That's from this explosion in volatility right here. That's what this is from. All of this. But you can see that it has been tightening ever since it's been in the range. And now the top end of your Bollinger Band and bottom end of your Bollinger Band is just outside. So that's 2 standard deviations. 1 standard deviation from the midpoint, and then another standard deviation from the midpoint. So you don't want to be looking for 3x or 3 deviation trades. You're only looking for 1 standard deviation trades. If you get a 5x deviation trade, then good for you. Right? Then yay. But typically when an asset's bullish, you want it to stay in the upper edge of the boundary, like in the top of the boundary. Once the boundary gets lost like this, it kept going as price stopped, then typically investors will wait for it to catch back up. Well, guess what? This week we've caught back up. And so far, we have not been able to close under daily support. So any test of this area looks like a good spot to get long. It does not mean you will make money, but this is the spot to look for long entries. Two days, 3 days, you've had the opportunity to get long there. So if you miss it, it is nobody's fault but yours. This is set to the daily. So I don't even know if you're going to get another test of this. 27,811. I would not doubt it I actually honestly believed over the weekend we were going to get that breakout. I did. I seriously thought over the weekend last week that we would get the breakout. But we didn't. The longer it stays doing this too, the less the probabilities are that it is going to break out. All right. We definitely do not want the daily 21 or the daily 20 because the midpoint of the Bollinger Band is just the 20 simple. That's all it is. And the outer boundary is the standard deviation move away based on the amount of volatility in the market. So essentially, what we don't want to see is we don't want to see this brown line start to act like intraday resistance. If it does, like cross price and then start to roll over, and then price starts making lower lows and starts, each time you get a pop, it runs into this thing and then gets sold off again, then that means the pullback is probably coming to the downside. So if it's going to run, I would like to see it run pretty damn soon. Now, like anything else, there will be traps. You will potentially get a day or two that's a trap. It happens all the time. But you can kind of see here, right? But this right there, I mean, that's just chops people up. That's why we don't like to use these as trade entries. We just use them basically to show us what the trend is doing. But here's a perfect example of a time when price was under the midpoint of the Bollinger Band and could not break down. That's another reason why I got bullish. Because you're trading under the midpoint of the Bollinger Band. You have already your volatility was squeezed out of the marketplace. So you're trading in a very tight 2 standard deviation range, but trending under the moving average. Unable to close below support. Hence getting long here. Look how tight the range got through here. Now this indicator lags price. So this tightness right in here was from these last few days here. So I couldn't see this squeeze before I took the position. I just knew it was coming because I have more experience. That's it. I just have experience. So if we continue to do this and then we lose that, and then we start trading in a tighter range but under the brown line, then I will flip my near-term bias to bearish. And I will look for that explosive move lower. But as of right now, everything is still up. We're still looking for the breakout to the upside. We still have a gap above us. We have a gap below us. We don't really care about gaps. We don't focus on them here in this channel, but you guys know that. There's only 33 people in here, so you all more than likely already know how we operate, but we're not focused on these gaps. But this could be the range for all of 2023. Like, this could be your 2023 high up here. No doubt about it. And this could be your 2023 low down here. There's nothing that says it has to go up, fill that gap, and then come back, fill this gap. It's just something I can see playing out, right? I could see the market doing that easily. Running up here, filling this gap, then coming back down, all the way down, filling this gap, and take all the rest of the year to do that. Then we get in 2024 and get close to the next halving. And if we're going to see a big bullish move like we have for the rest, or like we have the last cycles, the last bull market phases, the 4-year market cycles, then we should see a nice big explosive bullish move on Bitcoin. It just doesn't mean it will play out. So we'll trade the chart that we have. And as of right now, the chart that we have is structured bullish. I'll try to do live streams, more next week. I had a doctor's appointment Tuesday. That's why we didn't do one Tuesday. By the time I got back, I was tired and didn't feel like going live. So, but, I don't mind going live. I know why my voice is shot. It's due to my thyroid. I got hypothyroidism, so that's why my voice is shot right now. We haven't explored surgery or anything like that. They're trying to keep it under control via medication, but obviously it's not working. So we may have to do something like that, but we'll see, right? The info's still good. The voice is just scratchy. It's all good. But right now, watch your outer boundaries. Resistance 28,505. Lower boundary support 26,961. Current near-term support As long as you're not closing dailies under this Bollinger Band or the 20 simple, you don't need the Bollinger Band. You can simply put on a 21 EMA or a 20 simple. See here. Let me set this one as the 20 simple. And it's blue. You see how the Bollinger Band changed from brown to blue? Yeah. It's just a 20 simple moving average. It'll show you where the midpoint is. And you can literally look at the size of the candles. If the size of the candles start getting smaller and smaller and smaller, for like 4 or 5 days of really tiny candles staying in this range, but with the 20 simple above price, we will be looking to short resistance. But you guys that are in the Discord will know that, because we will be looking for that position together. Right now, in the middle of the range, it's a little bit more difficult for me to give trade signals. Because remember, this is the range. Right? This and this is your range. So as long as we're in the middle of that, it's difficult for me to give you trade ideas. I can give you trade ideas, but where are you going to put your stops and all of that? It's almost impossible for me to give you like the high probable scenario. But outside, over here or over here, yeah. And we're not going to be looking to short if we get up here either, right? Even though we failed and failed and failed at this yearly Heath level, that still does not mean that if we do break out of this and we do get above 29,190, that we're going to be looking for shorts. No. Absolutely not. Unless you get a massive rejection. But you did get a massive rejection here on this one when you took out that high, and you still didn't go nowhere. The very next day, in fact, stopped you out. So it's difficult to trade this range. What you can do is look for these small days like this when you get the breakout. So this breakout, wait for that small bearish day like that, and then watch. Something like that. 4 entries for the trend to continue. That's your standard, expansion, retrace, expansion move here. Boom. Boom. And that's a nice reaction off the line. Now, I don't know if you can get a retest of this or not. But if you got a ton of momentum to the upside on the short squeeze, so here's the bearish day. Still a good chance to get stopped out. Right there. Happened at noon. See how it held that support right there? And this is ultimately the daily bearish close. This is your daily support here. That was the close of that day. So I guess it was the bullish close of that day. Phenomenal entry right there. I just don't like the time. And then you got to worry about the London session taking you out overnight. But it doesn't. It starts to trade away. So you're golden at that point. I'm not awake during the London session, so I can't guide you and give you advice, but that's what you're looking for. Something like that. And then we get to the range. And then we start to build the range. So you don't always get these, but they happen quite frequently. You got two of them here. They just look so tiny in comparison because the amount of volatility that we had here was nil, right? It was literally nothing. And with those nasty wicks there, look at this wick on this day. It traded all the way back down to this bullish breakout. So you did have a pullback day here. Then you pulled all the way back to this candle's open. Then you left. And it was, see ya. So you could look for something like that, but just understand that each time you look for bids, each time you look to set on the bid, especially above 30 grand, you're getting very extended. And I do realize and I do understand that you are making bearish divergence on the RSI. So that's going to get shorts loading the boat. But we need shorts to load the boat here. We need Capo and Profit Blue. But Profit Blue just changed his bias from bearish to bullish. So I wouldn't doubt it to see a nasty dump now. Those guys suck so bad. It must suck to them. Literally be always on the wrong side of the market. They were on the wrong side of the market here. They were on the wrong side of the market there. Here. Price has to move up 100% before they're bullish again. And I think Capo is still bearish, still calling for 10K. Give it up, bro. Michael Saylor owns almost every Bitcoin mine at this point. So the only way you're seeing 10K is if he sells everything. All right. Yeah, I gotta run too. Yeah, it is also right. And you do have a symmetrical triangle and they do break down or out, but I'm just not a pattern guy. But it is there. I mean, it is there. You do have one. Whether I'm a pattern guy or not, you clearly have a symmetrical triangle forming here. It is there. All you do, man, Matt, go over how you take your crypto holdings offline to cold wallet. Well, first you need a cold storage wallet. If you have a cold storage wallet, all you do is go into your assets. And then you'll see, like if you want to take Tether off, for instance, you go to Tether, you see how much Tether you have. And you withdraw. That's how. You just withdraw it. It'll ask you which chain you want to use. So with both Tether and USDC, I use ERC20, which is Ethereum's network. You put in the wallet address you wish to withdraw the funds to. You put in ERC20, and then you put in your password and hit send, and boom. Give it 30 minutes to an hour, and those funds should show up on your wallet. Now, I advise you to do a small amount first. Obviously, because I've lost money before. See, like if I'm sending the money to Coinbase, it's the same wallet address each time, whether it's Tether or USDC or Bitcoin. It's the same address. But if I use the Ledger Nano S, it creates a whole new wallet address each time. So each time I send funds from Bitget to the cold storage, it generates a whole brand new wallet address. So you got to make sure you verify that address on the actual Nano. Once you verified the address, then you send it. Send a small amount first. That way you make sure you get the money. Don't send it all at once, especially if it's a lot of money. Because all you need to do is be one digit off. And you will send that money to Nowheresville. Or somebody will just randomly receive all your money and think that they've had the best day of their life. There is YouTube video after YouTube video on that very topic on how to do it. Right? I don't have a fake Bitget account, so here. Let me just make sure. All right, here. Here, I'll show you briefly. Because like I said, I only have tradable funds on the exchange right now. So I'll show you. Here, let me go back to USDT, USDC. Because I don't have any money in this account right now. All right, so you go right here, assets. You're going to come over here, right? This shows your total equity. That's everything. That's whatever's in your trading portfolios, open positions, and then this is spot. There, you click spot. It's going to bring up this stuff here. Let's just scroll down to, let's say, how I got $4 of Solana, I don't know. Right here, there's $560 of USDC right there. You would just click withdraw. Withdraw it. Choose a coin, USDC, and then the chain. Remember, this is important. This has to be right or you will lose the money. ERC20. Click that. Confirm. And then you type it in or copy and paste your withdrawal address there. Then it takes you to another screen where it's going to ask for, it's going to ask you to give I have two-factor authentication, so I get an email and a text, and then I have to type in those numbers from the email and the text. Once I do that, I hit send, and then boom, it goes to the Nano S. Hopefully that helps. I just did it yesterday. I took everything off. Everything. So once that grows again, I'll do the same thing. I will drop it back down. Obviously, there's still a little bit of money on there, but if I lose $6,000, I'm not gonna cry about that, right? I don't want to lose $6,000, but I'm not gonna cry. It's not gonna bankrupt me either. But with $6,000 on Bitget, you can easily make a lot of money each week because of the leverage factor and depending on how good of a trader you are. I've literally doubled accounts on the Bitget exchange multiple times in a week before. Nailing that trade right there, freaking, that almost quadrupled the account. I took profits off from this one trade like 3 times already. So the amount of money that I'm holding on this trade really isn't that much. I think I'm holding like 3 grand on the open position worth of Bitcoin. Not a lot, right? Not a lot. So at this point, it's almost like now I'm at a place where I have to ask myself, is it even worth holding that open? Should I go ahead and close that position and look for a re-entry somewhere? Mainly, I leave it open so that way if anybody needs proof that, I trade with real funds or whatnot, I leave that position open just to prove that it's real funds and to prove the entry, the actual entry. Because some people don't believe that I actually got in here. Some people think that I'm running my mouth, that it's not true. Just like they don't believe that this USDG, that this short position is real, and it is. You know what I'm saying? This ain't real money. This is a paper account, right? That's why it's this isn't blocked out. Whenever you see this number blocked out, that's when you know it's a real account. Because the amount of money, you shouldn't even focus on the amount. The amount shouldn't even matter. You're trying to learn the process. So the amount should not even matter. You can't it's like I can't make a specific designed exact amount of money every week. Like if you need to make $400 a week in order to quit your job or $1,000 a week to quit your job, you're not going to be able to do that trading. You're not going to be able to consistently make $1,000 a week on a $200 account. You'll be way levered up. Can you do it? Yeah. I've done it. I've made over $1,000. I made $2,600 on a $300 opening balance on Bitget once. And that was just based on a very stupid 125x woo-ha play. Right? It's the process. Like, I didn't short this thing all the way up until I finally nailed the top either. I took this trade based off of the DXY. I took this trade on this day right here. And I took it live. Right there. at 113,920. Once we took out 113,920, I hit the sell button on USDJPY. This was the previous week's high, and we were looking for the dollar to roll over because we felt as if the dollar had topped out. We felt this was the top on the dollar, and that we were waiting on a liquidation of the previous week's high to short it. And I had been talking about the trade for weeks before it happened. I wanted to do it on USDJPY because USDJPY was a runaway freight train. So there was a technical reason to take the trade, and it was filmed live. Usually on this, though, I'm trading it on a paper account, demo account on screen, off screen over here to the left and to the right is where I have my broker lined up, ready to go. So I set the trade up over here on the paper account, then I take the same exact trade on the real account, just off screen. And occasionally I've taken trades on screen with real funds. It's not advisable to do that, I was told by a lawyer. So I stopped. Right? So I stopped doing that. It's the process that you need to learn. Once you learn the process, the money will come. Whether you can make enough money to survive or not, that's up to you. That's not going to be up to me. That's going to be up to you whether or not you can manage your emotions, whether you overtrade, whether if you're disciplined enough. Some people will never be able to do this. Some people will never, ever, ever be able to make it to profitability because they can't be consistent. They can't be patient. Or they overtrade, or they revenge trade, or they think they know which direction the market's going to go. Stuff like that. All of that is going to hinder you from being profitable in the market. We do not know which direction the market's going to go. We can get an overall bias based on technical analysis, but random market violence has a way of stopping you out and this and that. And if you keep trying to force the trade, yada yada, all that stuff is what's going to keep you from being profitable, not the strategy. And I don't charge a dime for the strategy. Not one red penny. I give it away for free on this channel. You're green on the day across all the assets now. Well, we've been talking. These things have moved up. So is that a deep enough correction? Maybe. I still don't think so, but that was bad news that we got earlier. So you would assume that this would be going down and the DXY would be going up. But the DXY is going to have trouble getting back above monthly support because it has broken down on a daily time frame. You haven't broken down below weekly support yet on a weekly time frame. You have broken down below monthly support, and you are contending with this monthly support as well. So you gotta break down. You need a strong close under to be considered a breakdown. And if that occurs, then this will be our next bearish target on the dollar. Right there. Then what I mean by that is we will take smaller intraday positions to the short side, ultimately aiming for this price. Once we get down there, it's anybody's guess, because the next monthly low is all the way down to $98. You could take this out in reverse and come right back up to here at 105 for the whole year. This could be a very sideways, choppy year. We don't know what's going to happen. We had 2 years back to back, multiple years of trend. We just come off of a 10-year trend on this, on the SPOOs. I mean, minus 2 months back in 2020. But I mean, ultimately, man, this thing has been trending. Last 6 months, though, you have not been. I would go further than that. I would say since June of 2022, you haven't been trending. You've been sideways. But we only care about now, where we are in regards to now, this year, because 2022's over. You're in a new year, so new trend. New quarter even. So what you did last quarter, this quarter, you could retrace every bit of it. I hope it don't, but you could. You could retrace every bit of last quarter. I would assume we'll probably retrace back down to 4K and bounce, but we'll see. Talk more about why going to Coinbase. I use Coinbase because I'm in America and it's an American exchange. But right now, since they got the Wells notice and Kraken's got a Wells notice and that, I'm just trying to get a lot of the useless stuff that I don't really like. To me, Tether and Circle are useless. They're useless. Because the only thing I'm trading most of the time, what I'm really trading on Bitget is the inverse swap contract. So I'm not using Tether to generate USD. I trade stocks, options, and Forex for USD. I mainly trade Bitcoin, but occasionally I will, trade USD or USDC if I don't want to mess up that other position, just to put real skin in the game with, the members of Trade Talk. Then I'll trade small amounts of USDT or USDC. But now that Circle doesn't have a bank, well, they do. I can't remember which bank they went to, but it's risky to hold that asset, man. If it becomes to the point where there is no exchange for me to use in America to get my funds, then those funds are going to be useless. It won't matter how much USDT or USDC I have if I can't get access to it. You need an exchange. There has to be an exchange, an on-ramp, off-ramp for your everyday Joe to participate in the crypto markets. It's peer-to-peer. You don't necessarily need it, but a lot less people are going to be, a lot less people are going to be inclined to trade it if they don't have a means to exchange. Tesla, we'll check out Tesla real quick and then we'll wrap it up. I know it bounced right where I said to watch for the bounce. Didn't I say 166.66 when we were up here? I said first watch here. Well, that didn't hold. Then here, then gap fill. If this doesn't hold, well, that held. One day it held. Boom. So if you took that entry, you should have taken profits already. But this, as long as you're not closing dailies under 166.66, it's still support. You do have a new support here that you tested today at 180.13. I don't know if this area holds or not. It just depends on risk sentiment moving forward. As long as investors are not afraid of inflation being sticky, as long as investors are not afraid of recession, then these are going to be the areas to look to add to your portfolio. Because that's how pullbacks work, right? When you're in a risk-on environment where you have risk-on sentiment, algorithms take over. 60-40 portfolios take back over again. And then you'll have areas where they will resettle once a month or every quarter. Well, where they will take profits and then re-enter. Take profits and re-enter. That's what forms these supports. That's what makes waves in the marketplace, right? People taking profits on shorts, rebalancing at resistance, re-entering. So same for the uptrends. When you get in an uptrend, you look for pullbacks to buy. There's a perfect example of that. This is a more aggressive moving stock, and it takes time sometimes. But there was support back here, right? Support. They added to their portfolio here. They added to their portfolio here. It's a simple strategy, guys. That's the reason it works. I just noticed it is all. So 166, when we were trading up here, I specifically said do not buy it up here. Wait for a pullback. This will be the first area to watch, but since it's so close, I probably wouldn't like that one. I probably would like this one. And if you lose this one, then watch for the gap fill. Those were my exact words. I can't remember when I said it. I said it sometime in February or early March. And boom, there it was. You got 1 day. Same scenario. If you lose this on a daily closing basis, make sure that you still have risk on sentiment and then watch 146.41. If your sentiment changes across all the market and it is no longer risk on, it is risk off, then you're probably not going to be looking to add at any supports. You're going to be looking to sell into resistance. But as of right now, it still looks like you have that risk on sentiment on Tesla, at least. Gold BTC correlation, there's not much of one. There's not much of one. And when you're looking at correlations, do me a favor and do that on the long term. Don't do it on the short term. Don't look for intraday correlations. Look for long-term correlations. Weekly, monthly, right? Weekly, monthly. You can see that you don't really have that correlation. Like when Bitcoin started its bull market here, I guess you could say that gold started one there at 1200. And by the time Bitcoin had topped out, gold had already topped out and made new lows. Then went up and made new highs, but Bitcoin was already in its bear market phase. So this is a weekly time frame. Bitcoin topped out 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, what, like 18 weeks before gold did? And then gold pulled back. So, I mean, there is a slight sentiment there. This is completely inverse. Bitcoin making fresh bear market lows as gold moving higher. I see no correlation there. Same scenario goes for here. Gold making new highs, Bitcoin running on the lows. Gold moving up, making all-time highs as Bitcoin's still trading sideways. Right in here is where we got the Bitcoin halving. By that time, gold had already topped out and made all-time highs before Bitcoin even started to run. So to me, there's not much of any correlation with gold and Bitcoin. There might be now, slightly, but I mean, that's argumentative at best, right? It's argumentative at best, subjective at best. If you want to look at correlations, do it on a longer term time frame. And you want to see those correlations be pretty close, pretty accurate, within at least 3 to 4 weeks. And finding correlations isn't going to help you either really nail perfect entries and exits, right? It might get you close, but you're going to find that not many things. The only thing that are really correlated in this marketplace is the dollar and the Euro USD, and they're not even 100% correlated. It's like 60-40. But like I said, Tesla on the long term, wait for gap village in the village, 141. Or if 166.66 holds, you could potentially add some to your position there. Yeah. All right. All right. You guys have a fantastic rest of your day. As always, make sure you guys trade safe, trade smart, and happy trading, everybody.